And I would like to welcome you all to the second year of our Real Estate Investors Group. I also want to thank the National Black MBA and New Life Property Management for providing the resources and coming together to make this possible. Again, like I said, this is our second year, and what we did last year was we brought in a different variety of speakers to educate our audience about real estate topics. So we wanted to take it one step further this year and really get into the bones of what people are dealing with when it's time for investment transactions. So today, what I want to do is I want to introduce our speaker. He's going to be talking about introducing our investors group meeting, Ken Moultrie. Ken is a Cleveland native, receiving his bachelor's from Kent State University and his MBA from Case Weatherhead School of Business. Ken is a manager partner with New Life Property Management and New Life Security, and he's also the founder of eRealty Zone, which will launch in September of 2007. Ken has real estate segment responsibilities for the Global Treasury Department at Key Bank. Ken has more than 7 years of experience in real estate investing. In this experience, he has owned and sold more than 18 residential and commercial properties. He has participated in $1 million deals. Ken is also a real estate agent and a professional of Global Treasury. Everyone put their hands together and welcome Ken Moultrie to the podium.
Thank you, Terry. Welcome everybody to another year. We're excited about this year because we structured the group based on a lot of feedback not feedback from the mic, but a lot of feedback that we received last year. The exciting thing about this year is each meeting we're focusing on a topic under the fundamentals of real estate investing, and we're going to go really deep into it, and we're bringing professionals in to really help you understand the different steps. So we're here to talk about real estate. Why real estate? Well, real estate is one of the few investments where you can come with no money and begin to invest. It's like, well, you can't go to a stockbroker and say, I want to buy 100 shares of Microsoft, and say I don't have any money. So after they start laughing, you pretty much wouldn't get anything done. So real estate is the only avenue where you can do that. Real estate is also the only avenue where you can actually make a profit, but report a loss to the IRS and not get arrested for it. Real estate is great because if you look at the Fortune 500, many of the people who made their money made it through real estate. Well, why not real estate? Well, real estate has caused many people to lose their life savings over 1 or 2 projects. And real estate also is difficult, it's challenging, and if you look at a lot of the court cases that happen, they might be tied to real estate. So why are we here? Well, the investment group, I'm sorry, let me fix this mic because I'm getting a lot of feedback. The investment group, we're focusing on, our belief is if you understand what you're doing, if you have good fundamentals, you build the appropriate resources and have a great blueprint, your chances of being successful increases exponentially. So, and that's the purpose and that's the involvement that we want to encourage with the group. And the good thing about real estate, we all can be successful in it. So your success is not taken away from her success. It's not taken away from my success. And we want to leverage the group so that we can help each other in terms of the whole process. And one realtor came up to me not too long ago and said, well, I have a property that's worth about $110,000, and you can get it for $70,000. So immediately that's $40,000 in equity. And I want to ask the group, is that a good deal? Those who say yes, raise their hand. Those who say no, raise your hand.
Okay, those who need more information.
And those who say we need more information, raise your hand. And then the realtor went on to tell me that the property needed about $30,000 in repairs. Is this a good deal? Yes. Or is it a bad deal? No. Or you still need more information? Then I found out that the property is a 2-family. Each unit is bringing in $1,500 in rent per month. Is it a good deal or is it a bad deal? See, the great thing about real estate is a good deal for you can be a bad deal for someone else, and vice versa. So really, and that speaks to the point of we all can be successful in real estate. Our belief is we created a model called the fundamentals of real estate investing. And with this model, it really helps you understand the big picture. And understanding the big picture really helps you drill down and understand, well, the first meeting, and I think you should have the dates on the slide. The first meeting, we're talking about foundation. And foundation is one of the most important steps, but unfortunately, a lot of people skip the foundation step. And as a part of foundation, you're determining your blueprint for success. You're creating a business plan and really understanding what you want to get. And a lot of people, excuse me, and a lot of people skip the foundation step and jump right into finding a property. But as you notice when we asked about the example, a lot of people say, well, this is a good deal, this is not a good deal. But in your foundation step, you really go to determine what's a good deal for you. I met one investor, he says, before every property that I get, I usually put in about 30 different offers. And that might seem like a big number to you, but at the same time, he understands what the property has to look like and how it has to feel before he goes through with it. So the foundation step, we will bring financial advisors talking about how to prepare yourself to invest in real estate. We're also going to talk about how to create a strategy for yourself that you can use throughout the other steps. And the other important step of foundation is also building your team. You need to build your team before you even get started. Understand the different people you need to have around you and build a level of trust so that you'll have support as you go on. The next meeting, we're going to focus on finding the property. Well, now, by the time you get to finding, you already know what you want. So you're going to go to the realtor and say, well, this is you know, the particular property I want. It needs to look this way. It needs to feel this way. And it makes the process a little easier. And also, it also supports your direction and your goal. Everything that you do, it should tie back to what your strategy and your goal is. So finding a property is, it can be a challenging step and it can take some time. But you also have to be patient because you don't want to end up with a property just because somebody told you that it was worth 110 and you can buy it for 70. Because the other question is that we didn't mention is, well, I could have asked the realtor, well, where did you get your numbers from? We just assumed that the realtor knew what they were talking about, but the reality is you need to be able to verify the numbers yourself, understand how they got to the numbers so that you can say, okay, I really agree with you. I remember one property that I bought, a realtor told me, and property is worth, I bought it for like $10,000, and the realtor told me that, well, you know, in about 4 or 5 years, the property is going to be worth $200,000. And, you know, the numbers sound good, but after looking into it, he was completely off. So the good thing was I had the knowledge to know not to just jump into it because he threw some numbers at me. So foundation, finding, and the next step is financing. And as we talked about assembling your team in the beginning, when you go into the financing step, you should already have the mortgage companies or a group of mortgage companies that you work with. And also, before you get started, you also want to talk to them about the different programs that they have available to support the deal that you want. And this makes things easier and you get pre-approved, but also there's a lot of discussion about predatory lending. So in this particular meeting, we're going to talk about predatory lending. We're going to talk about how to approach the financing step. And we're having Charter One, and they're talking about some of the different programs as well as SureBank at that particular meeting. And we may have a few mortgage brokers there. The big difference between mortgage brokers and mortgage banks typically own their loans. Mortgage brokers more or less originate the loan. So these things we're going to talk about further on in that particular meeting. After financing is the fixing step. And the fixing step is extremely important from the standpoint that you know, it can cause you to go out under budget. It can cause you to pretty much cause your project to be unsuccessful. When we look at fixing, there's 3 components that we need to make sure we have in place. First, well, we want to make sure we can acquire property, so we talked about that in financing. But also, you need to make sure that you have reserves available just in case if you mess up or things don't go as planned. The other part of the process is you need to have holding cost money. And a lot of people forget about the holding cost because they just think about the project. I buy it for $50,000, I put 20 into it, and I can do whatever I want after it. But the holding cost, depending upon how long the project is, it can be very expensive. I'm going to tell you one of my first few projects in terms of fixing. I didn't know anything about fixing property, so I picked up a hammer probably once or twice when I first got started. So what I looked to do is I had a friend who said, you know, I do real estate investing, and my father, and we've done a few projects. So I used them for the first project, and it went relatively well. But if I know now, if I knew now what I should have known, I mean, if I knew then what I should have known, I probably wouldn't have went with them. But after that property was successful, I bought it for about 30, and I got an equity line, and that allowed me to continue to invest. I bought a large building, and he said, yeah, I can do that project as well. He promised me 3 or 4 months to renovate the property. A year later, I fired him because the project wasn't done. Well, it was one of those things where I had the relationship, and I got to the point where I was there day to day, but, you know, it got to the point that said, you know, we're not, you know, we can't move on. But we progressed throughout the year, so after I fired him, I brought somebody else in to finish it up. But the important thing to note, just because a person is a contractor doesn't mean they understand project management. And just because they're a contractor doesn't mean they understand the whole process. So as a part of this particular meeting, we're going to focus on how to work with contractors, also how to create your own project plan to make contractors commit to. And also in this particular meeting, we're going to have some people from the housing department. One of the things that they are encouraging, especially for new investors, is to pull permits. A lot of contractors recommend that you don't pull permits because of the cost. But the benefit to you is you have an expert. So after the fixing step, the next step is either freeing, which is selling, or filling. And both freeing and filling, they kind of are tied to marketing. When we think about marketing fundamentals, pricing, promotion, place, product, the pricing is hugely important. A lot of times as an investor, you don't want your selling price to be driven by your cost, because that doesn't give you a lot of flexibility. And what I mean by that, you buy a property for, let's say, $70,000, and you put another 20 into it, and here you're into the property 90, and it's worth about 95. So at the same time, someone else bought the same property that looks exactly like yours, and they're only into it 70. So needless to say, they have a lot more flexibility with pricing, and you, on the hand, you have to pretty much cover your costs. So when you buy properties, you want to think about that if part of your strategy is selling it. And this particular meeting, we're going to talk about some of the approaches that you can do to make sure your property sells, to make sure you position your property well against other people's property, because pretty much that's the key to make sure that you distinguish yourself and your strategy. I ran into one gentleman, he said his strategy is to buy properties and make them luxurious. And you know, I questioned the strategy, but you know, he figured this is what I'm going to do with every property. But the difficult thing comes when a person buys a property, say in Cleveland, say the tenant messes the property up. Well, do you spend $300 to get a tenant back in, or do you spend $1,500 to get the property back to luxurious again? And you know, a lot of people don't stick to their strategy when they come to that decision. So it's important that you evaluate what the basis of your strategy is. When we talk about filling, marketing fundamentals, again, if you can rent your property for cheaper than your next door neighbor, chances are a tenant is going to choose you, especially if the properties look the same. In this particular meeting, we're going to bring some individuals from Section 8. A lot of people deal with programs like the subsidized programs, and also the eating group. They also have a program. So filling the property is an important step, especially given it's really hard to flip a property. Flip meaning selling it within 1 year. A lot of banks won't finance your buyer unless they have extremely high credit score. So, and one of the things that is important to know that, because some people say, well, I'm going to buy this property and sell it in 3 months. And the reality is really difficult to do that. So there may be a holding period that you have to accommodate. And to make the holding period a little easier, you might choose to get a tenant. So this is going to be an important meeting in terms of how you structure your strategy, and also as a backup plan. You have to understand, well, what if I don't sell it? What are my options? And this is what you want to talk about in the foundation step, because your options you don't want your options to put you in the red. So we talk about foundation, and that's pretty much building your blueprint, building your business plan, building your team. We talk about finding a property, working with realtors and making sure you get the right property, financing, mortgage programs, protect yourself, make sure you're not getting into a predatory lending situation. Gentleman that I sold the property to is suing me. I said, what could he possibly be suing me for? As soon as he got the property, he found out that one of the tenants was choosing not to pay. And he said, well, it's your fault. You didn't tell me that that tenant wasn't going to pay and probably move out in a short period of time. And I didn't think that. I said, you know, this is real stupid. I'm not going to even, you know, prepare for this. I'm just going to go to court and tell them, you know, it's not my fault your tenant is moving out. But I didn't really prepare for it. And the mistake that I made was I interacted with him myself. A realtor is licensed. They also have insurance. So if that type of information was communicated or wasn't communicated, it's more or less the responsibility of a realtor as opposed to yourself. So you want to be careful in terms of if you want to interact with the seller or not, because the seller can bring you in court. And I would have rather in that situation to say it was his fault, it wasn't my fault, he should have told you what you wanted to hear. So when we talk about facilitation, we talk about insurance, and we talk about protecting yourself, and we're talking about making sure that you can accomplish the goals that you want to accomplish. So these are the fundamentals of real estate investing. And as I noted, each meeting is going to focus on a topic. We're going to bring experts to give you some more insights, and we're also going to give you some information to take away with each meeting. And you know, I don't claim to be an expert in all of the areas, but I understand the big picture well enough to know how to manage this process. As an investor yourself, it gets more difficult when you're in different stages, when you're finding a property and you're financing another property and you're facilitating properties, and you can imagine how you can get pulled in many directions. So you want to position yourself, what do I want to be an expert of? And what do I want to allocate my time to? So good luck, and I'm glad everyone's here, and I'm excited about the investment group for this year. And what I'll do is I'll open it up for questions or comments. Yes. That can be a relatively difficult process. I work with someone as a realtor, and actually was just a friend. I typically don't do realtor stuff, but in that process there's a lot of paperwork, and there's a lot of time in working with the banks. But the good thing is in a pre-foreclosure, most banks are excited about doing something. I was reading an article the other day. It says each bank, on average, it costs them between $50,000 and $60,000 on a foreclosure. So it's to their benefit, and sometimes they only get 50 cents on a dollar. So a lot of times it's to their benefit to participate in the process and to work with the buyer. But the important thing to note, you have to have a certain amount of information. You have to provide it to them a certain way, or depending upon the bank, sometimes they won't talk to you. So those are just some things that work, and there's some techniques involved in doing pre-foreclosures. Good question. When we talk about the facilitation and we talk about the entire process, insurance is extremely important. One of my buildings, and actually insurance has helped me in my process. One of my properties, I'm driving down the street and I see a fire truck in front of my building. I say, this can't be my building. And when I pull up, it was my building. So fortunately, the situation worked out good for me because no one was there. The tenant wasn't in a place. She actually left her stove on with grease, and it just burnt up the unit. But the good part of it was the fact that I had insurance, and I was able to get a check way higher than it cost me to fix it. But at the same time, not having insurance, it would have put me in a bad situation. So, you know, insurance is very important. And in a facilitating meeting, we will have, you know, people on the panel, so we could talk about you being one of those individuals.
Ken, are you going to be talking about both residential and commercial properties throughout the series, or one or the other?
Yes, the professionals that we're bringing in, they're going to have a mix of residential and commercial experience. Me personally, I've done few commercial deals, but I work in commercial banking, so I deal a lot with companies that do commercial investing. So there will be a mix.
As kind of a follow-on to that, could you also differentiate between the benefits of a multifamily building versus a single family, especially in this Northeast Ohio area?
One of the biggest characteristics is single families are a little easier to finance. I found out The first thing that I bought was a single family, and I was able to get an equity line in a relatively short period of time to reinvest. I could not have done that with the two family. And the biggest jump in terms of comparison is when you jump over 4 units. When you go over 4 units, you're talking about commercial, and you're talking about insurance going through the roof. One 7-unit building that I had, I think my insurance for the year was like $2,400 a year. In comparison to like a 2-family, it was only $500. Might be your profit for the year. So, you know, depending upon what your strategy is, how long you plan on holding the property, do you have access to tenants who want to stay there for a long time? These are the things that you think about in your foundation step.
Are you going to be talking about the environmental implications of knocking a house down if you go and buy an investment property that's too dilapidated to renovate or fix up and resell? And I've heard that, especially in the city, that there's different environmental codes that whatever you buy above ground.
Topic that we've planned to cover, but at the same time, I think we're bringing some people in who work for the city, and that might be a topic that we can ask them to speak a little bit on. But it's very important because all the vacant properties we have and all the dilapidated properties that we have throughout the city, environmental concerns is definitely one of the issues that need to be monitored, as well as safety.
Given this market environment, if you have a 2-family and a single family, and your goal is to buy, rehab, and resell, in this environment, and considering the holding costs, which one would you do if the numbers were about the same, profit-wise? If you're going to make $20,000 on both, in your estimation, which one would you choose to do, the single or the double?
It's hard to look at it single versus double, but one thing about singles, the market of buyers is maybe a little larger than doubles, because not only do you may have an investor who want to buy the property to rent it out, but also you might have someone who wants to stay there. So the potential of people who can buy it, and also the programs for home ownership, there are a lot more for those than there are for 2 families. So that's something that you may consider, because you might have a better market for the single family. But on the other hand, a lot of people buy the 2 families. Some people buy them to live in, and sometimes they do have access to those programs. So, I wouldn't use single or double as the only factor for making a decision, unless he's bringing cash, which, doesn't happen, may not happen often, or unless he has like extremely high credit score like 750. So in this case, and it makes it a little difficult, you plan on having a property for a year and you rent it out, and then after the year you want to sell it. The person standing there might mess up your property a little bit, and it might make it a little more difficult for you to sell. Or at the end of the day, when you sell it, if I already got a tenant in it, and I'm a home, and I want to be a homeowner, and there's someone already living there, I might say, well, you already got somebody living there, and it's the process. We not only have contractors, but we also have people who work with the contractors, and we also have the city as well. The director of housing for Warrensville, I believe she's going to be here for that meeting. So we have a lot of exciting meetings in store for you guys this year. Any other questions?
How would you evaluate buying in the suburbs versus buying in the city of Cleveland?
Great question. Do you buy in the city of Cleveland, or do you buy in the suburbs? Well, let's look at that in comparing a 2-family in Shaker and a 2-family in Cleveland. Well, just off the back, the 2-family in Shaker is going to be a little higher in terms of purchase. Taxes. And the other big thing is taxes. So the cost associated with, and the amazing thing is, I look through listings. The amazing thing is, when you look at the numbers of some of these properties, of a lot of these properties, let's say Shaker, the numbers don't work out. And what I try to figure out is, how does this person expect to sell a property? But a lot of times, the 2 families in Shaker, the market is for people who want to stay in them as well. They may want to stay in the bottom half and rent the top, or vice versa. In Cleveland, you get great prices. But at the same time, you have to worry about vandalism throughout the process of fixing your property, as is Shaker. But at the same time, it's a big deal in Cleveland. I know one property that I had 2 break-ins in one weekend, And this was in both break-ins, it cost me about $3,000. Now these people were bold because what they probably did was watch the property, watch when the contractors come in and out. But these people were bold enough to take windows out of the property overnight. But one thing that I didn't know about when I first got started is a security system right there that works without phone or internet. So the great thing about it is all you need is electricity in a property, you plug it in and it'll call the police. So if I would have known about that back then, I probably would have extra $3,000 in my pocket. But when you compare city properties versus Shaker, you know, and typically properties in city, more break-ins, but Shaker or Garfield, you get higher rents. And I'm not going to say better tenants, but you typically get tenants who have better paying jobs, or you might live near a particular property that you want to buy.
Will you be addressing, or a professional be addressing the impact on your credit for purchasing, if you're purchasing multiple units?
Mm-hmm. The first meeting, when we talk about foundation, that's one of the topics, credit. How do you prepare yourself? What type of reserves you should have? And the implications of having higher credit scores versus lower credit scores. Really, you want money as cheap as you can get it, because deals look a lot better to you than someone with a lower credit score. So that is one of the topics that they'll discuss in the meeting. And just in terms of topics, are there any specific topics that we want to be covered outside of or within the arena that we have? Actually, did you have a question?
I did, just because I've heard of kind of starting an LLC or a business under whatever name you want,
Mm-hmm.
putting all your properties under there so it doesn't affect your personal credit.
Yeah, that's the best approach to do. Pretty much in corporate banking, that's what all the home builders do. Every project that they do, they name the project, and sometimes they just name it based on the address, but that's the standard. The difficult thing is getting financing in the name of the LLC, because pretty much you're creating a company, but the company doesn't have any history, and it doesn't have any proof of income over the last couple of years. So you're not going to go to a bank and say, hey, this is my company, I want to get a mortgage because my company owns this property. So on the initial stages, you probably have to personally guarantee if you find a program that allows you to do that. But to your point, that's the route that you want to go.
And are you going to touch on like tax abatement at all and properties that allow you to, or any type of rehab that allow you to take advantage of that?
Tax abatement, I'm trying to think what topic that will fall under. I guess finding. Okay. Yeah. I mean, like I said, the professionals here, we can bring up these topics and have them speak about it. But we can make a note to have them prepare to talk a little bit. I know a lot of tax abatement is tied to a lot of the newer homes, more so than houses that already exist. But there are programs out there that you can take advantage of. Way in the back.
Are we going to have somebody from the bank that can educate us on who or how will we get to somebody dealing with the foreclosures, pre-foreclosures?
That is a question that you can ask. Like we know that we're going to have Charter One and Shore Bank. Well, they're working to be more friendly, but at the same time, it is difficult, depending upon the bank, to get to that list. And one of the reasons it's difficult, like for instance, Key Bank. Key Bank typically doesn't service residential loans. Last year, they had a total of maybe 10 foreclosures, because as soon as they originate the loans, they sell them off. So if you go to Key Bank and say, tell me about your foreclosures, and they say, well, we only got one or two. But the other thing to note is a lot of times other companies handle it on their behalf. So it's an asset management company that handles foreclosures. So really getting to the asset management company is who you want to talk to, because they do that. They